Friends, good day. If you decide to trade options on the Binance exchange, make sure you watch this video first, because I'm about to show you the results of trading options on Binance exchange. I will tell you about the disadvantages and problems that the Binance exchange has when trading options. This video is not a tutorial, it is a practical part. Let's imagine a situation like this. There was a major liquidation recently. It may have been a large Bitcoin sale by Elon Musk's SpaceX company. They sold all the Bitcoins they had on their balance. I have always said, if volatility is dead stopped and price is in a narrow channel, it means that something is about to happen. A rise in volatility is going to happen. A strong move is going to happen. It is difficult to determine whether it will be up or down, but the fact that there will be a price movement remains. Right here, where I'm showing, I tried recently, when Bitcoin was at 30k, to buy Binance options, just to see what would come out of it. And indeed, there was a big drop overnight. Bitcoin fell from 28,600 to below 25. On cryptocurrency exchanges, liquidations sometimes happen. Daily volatility rose to almost 170. Naturally, buying options performed perfectly. But, and it's a very big but, that I'm going to talk about in a moment. So, take a look at the position I bought. I bought put options of strike 28 at the price of 557. I bought call options at strike 32 and 34. You already realize that basically I bought a strangle. I hooked up our trading robot, which performed delta rehedging. When volatility started to rise, I started to make money with futures. When it went down, the robot bought futures. When it went up, it sold them and worked with spreads. Plus, options were getting more expensive on volatility, put options were getting more expensive, and since the strategy is trend following, I was making money with the delta. Eventually, my futures position was liquidated. Well, the Binance is the place where a bunch of different markets within one exchange come together, and the risks didn't summarize between them. I mean, I have an options account. I make a profit there, plus $328. But with futures, I have different account and went into minus. It was a small minus, but it was there. And even though I was in a big plus in another position, I got a liquidation. I got an email from Binance and my position with futures was liquidated at 25 and 486. Very bad. Terrible price. Nothing good. I couldn't make any money on it. Despite the fact that I chose the right time, I bought cheap options. I turned on the robot. A powerful movement was realized here. Look at it. Because of this, my put options made a good profit. Call options have lost in value, but they cannot lose more in value than their premium. But the put options went up, more than doubled in value. What am I saying? They're now at 1,779 and I bought them at 488, which means they've quadrupled in value. But because there's no risk summation between options and futures, practically its basic asset, I got liquidated, fixed a loss, and this loss ate my profit for options. It turned out to be a completely pointless trade. Not only that the options on Binance are not margined, that is, if I bought a certain amount of options for 487 USDT, for example, that amount of money was deducted from my account immediately. The premium is deducted immediately from your account as maximum risk. No margin requirements, just the entire premium you paid for the options is taken from you. You can't sell options here. I think it's an outrage, because there is not even a risk module for trading options. I mean, what for? You bought $100 worth of options, they were withdrawn from your account, and you won't lose more than $100. I don't know why such a big exchange treats options traders so badly, but it's horrible. I don't know if it's done on purpose or it is some kind of design flaw. Also here, IV is different for call and put options. This is nonsense. I'm not going to explain why it's done that way. Is it ignorance? They don't know that in the Black and Scholes model, there is a parameter bet. Just add the parameter and all the option calculations will be correct. The different IV for put and call options is just wrong and stupid. Or was it done on purpose to make it easier for local market makers to cheat people? I don't know. I don't get it. Everyone knows that according to the put-call parity rule, if you can't calculate the price of the basic asset, it's effectively a risk-free trade. I don't know. Anyway, options here make good profits, but futures used in hedging can easily be liquidated, and they close your position with a very bad price. My friends, this is not the way to trade options. There is no risk summation, there is no hedging, there is no option selling. Volatility is calculated incorrectly. I'm washing my hands, because it doesn't make any sense. However, the final decision is yours. If you found this video useful, leave a like, subscribe to the channel if you haven't already, share your thoughts about trading options on Binance in the comments. I wish you all the best, have a successful options trading.